You are listening to Lender Lounge with Kevin Kim, a podcast dedicated to helping those in the private lending industry grow, improve, and streamline their business. I'm Kevin Kim, partner at Gerasi LLP, the nation's largest private lending law firm. Join me as we chat with the best and brightest in private lending, who are eager to share their years of wisdom and best practices with lenders, borrowers, brokers, investors, and more. Subscribe to Lender Lounge on your favorite podcast platform and learn more about Gerasi and how we can work with you at gerasilawfirm.com. Check out the episode summary for other valuable resources. Hey everyone, welcome back to Season 5 of Lender Lounge with yours truly, Kevin Kim. I am truly excited to bring back a guest today, one of our favorite clients and one of my favorite people in private lending. Ben, welcome back to the show. For our audience who don't know who you are and don't know about Constructive, please introduce yourself to our audience and we'll get started.
Yeah, no, thanks, Kev. It's great to be here. And to your point, I'm a returning guest, so I have my Lender Lounge microphone from the last time. I will have to note you didn't send me a new one. I've got my Lender Lounge coffee mug.
Hell yeah!
And if you want a real plug, and this is my everyday mouse pad.
Nice.
Man. So I have my Gerasi affiliated swag here. But look, it's great to be back. You know, Ben Fertig, I'm the president of Constructive Capital, and Constructive deploys capital into several residential investor asset classes, most primarily DSCR rental loans and residential transitional loans or fix and flip loans. Those include, bridge, ground up construction loans. And we do everything through a network of third-party partners. And just a little bit of background, the company was incepted back in 2017. And believe it or not, and I think, you're obviously very familiar with our operations, both as counsel in some cases and as the provider of our closing docs through Lightning Docs. So we've been at scale for quite a while. At a 9-figure monthly run rate. But believe it or not, this is going to be our largest origination production month. And last month, up until this month, was our largest production origination. I'm not sure why exactly. I don't think there's anything that is specific within the market conditions. And I think you and I talked a little bit offline that you're not necessarily seeing that across the industry or your client base. But things are extremely busy over here.
First of all, congratulations on the best ever month. Always nice to break records. Internally, we've always been excited to watch your guys' growth, and we were really excited to partner with you guys through Lightning Docs and at the law firm when you guys, came onto the market. But we, as counsel and as your loan doc provider, we've seen one perspective of the business, but there's a lot of other things that happen behind the scenes, and our audience. Most of our audience, likes to listen to learn, right, from those who have built their businesses, learn from mistakes, listen to their advice, and so on and so forth. I think it's a good topic to have today because, within a 7-year window to get to a 9-figure run rate, that's supremely impressive. But it couldn't have been easy, right? And so, kind of give us a little bit of the key milestones from during those 7 years as you built out the company, because like a lot of folks don't know the detailed history and the milestones of Constructive, right? A lot of folks know you guys, a lot of folks work with you guys, but they don't know a lot about your story, right? Where a lot of the other companies, they've been around a little bit longer, and they've cut, they're more, I guess we can call it well known out there when it comes to the backstory. But that's part of the show, right? We want to give the backstory behind the business,
Yeah, look, and I mean, I think there's a lot of key takeaways, I think, from the backstory that I hope are relevant to the listener base. But the company was incepted in the fourth quarter of 2017. which was a partnership between myself and, at the time, the second largest specialty servicer of residential assets, or the ownership group of that servicer, who now is the largest specialty servicer of residential assets. Look, we made the first loan in 2018. It was me and one other individual, who her and I were basically out of a basement office that the owners had maintained. And look, I think one of the things that we did, and we did grow quickly, because I think everybody, from that perspective, when you're a startup, does, at least on a relative basis. We grew quickly, but we were very focused on risk management. So the growth was organic. We knew that over time, at the end of the day, when things get difficult, you need to have access to capital if you're in mortgage banking. And, just throughout my career, I've been mortgage banking 28 years now, and I've been through a few crises. I think there was some difficulty, I think, getting off the ground. We were certainly, by design, missing opportunities, I think related to how we were looking at risk. But, we started to build the company. And I think throughout 2018, 19, and going into 20, we started to see organic growth that was exciting to us. And then, we had gotten to the point where we really were comfortable. We'd scaled the business, and we were actually, this is no joke. I mean, I was out at your conference in Newport. You had it in February, the year of COVID. It was strange because you and I both know it was like, you had heard of COVID, but everything was still pretty normal.
Yeah.
Went to the conference. We weren't wearing masks. We were out, going to dinner, fly back, right? And we were in the middle of, our pipeline was growing. So we took off in March, and there was just no question it was going to be the best month in the history of the company. And then you get to that third week of March, and everything just seized. The equity markets, of course, our capital markets. So we got the reputation for actually lending through, if you remember, what most people called, the COVID shutdown. But that really wasn't done strategically. We did make a few loans where I think we felt that, the liability of not making those loans was probably worse than making the frickin' loan. But, so, and at that point, what had happened was the preponderance of what was in our pipeline, we didn't fund. So we had all these broker clients that had borrowers that were obviously extremely unhappy. But what we did is, we engaged in this campaign where we went back and we tried to make everybody whole that we could. Cost us about $500,000. Got into refunding, or reimbursing, I should say, some of the underlying borrower base of our clients, earnest money, for instance. We had paid out a couple of, $22,000 refunds for borrowers' earnest money. And, so I think, like, relative to the situation, nobody was happy, but I think that resonated. And then, as we kind of worked through that time, we had a number of loans on our balance. We had a fairly large population of DSCR loans on our balance sheet that, were certainly worth less than par at the time because there was just no bids in the market. And, we ended up taking a loss on those loans, but we moved on. I mean, thankfully, we were capitalized enough to be able to do that. And then, as I don't know, call it July, maybe it was June, a couple of aggregators came back into the market. We got going fairly quickly, and we brought some momentum into 2021. And then, as 2021, the entire capital markets infrastructure seemed like it was grossly underinvested, and 2021 was a renaissance for just about everybody, including Constructive. So we got the business to, we picked up the scale again. I mean, we got the business to critical mass, and but one of the things that we did was, especially when it came to DSCR, is we focused on diversifying our capital sources, and I think that when 2022 came along, and you had this more, I mean, it was a crisis. It wasn't maybe as traumatic. It was over time, right? But everybody was struggling with the difficulties of the rising interest rates from really right from the first of the year in 2022. We had gotten into a partnership back in 21 with a direct partnership with a life insurance company that you would know if I told you. And the reasoning was, we actually approached them back in March of 2020, and they said, "Look, if we would have bought through this. I mean, a dysfunctional credit market. I mean, it's just there's just a different perspective and economic model around the loans for an insurance company, right?" So we said, okay. So we got into a relationship in 2021, actually. So when we cascaded into 22, everybody got into trouble if you were, effectively exclusively tied to the securitizers, because the bid had dried up, or the bid had changed so drastically that you found yourself just retrading your clients or borrowers by 200, 250 basis points in some cases. And we had stable capital through there. So, I mean, that was another ramp, that was another, accelerator of growth. And we continue that relationship today. And I think one of the things that most people know about Constructive is that if you've heard us talk on panels, if you've heard us talk to our client base, if you've heard us speak at conferences, that we are diversified when it comes to our capital. We do a lot of DSCR loans. We've happened to actually also ramp up our fix and flip, our RTL business, very recently. But I think the diversification of not only where it's derived from, whether it be insurance, from the securitization market, or even, to be honest, we've done some business with some banks. I think that's been critical. And it's also the way that we have that capital committed. So we bring in capital in the form of forward commitments, which, we actually will lock price for 60 to 75 days. Now, depending on what happens subsequent to your lock, I mean, that could be good or bad, but it's at least consistent. And we pass that out to our client base. And then we do maintain, an index-based price model, so that if rates go down, we could take advantage of that. But if rates rise, we have our forward commitments there. And I think, at some level, they counterbalance each other. But, the weighted execution, has been really good for us. And not only are these 2 months going to be our best 2 months in terms of production, they're going to be our best 2 months in terms of net income.
That's kind of nail holding on the capital side, because you're talking about key decisions you guys made right during the exit kind of off ramp during the COVID crisis into 21 and 22, and that paid dividends. But from a internal, I guess, operations standpoint, was that a kind of core decision that you made and pursued? Was there a team in place? Like, I always wondered how the sausage is made behind the curtain at Constructive, like, because you guys don't have a massive team. Like, you have actually a remarkably lean company.
For the amount of loans that we do, we have a remarkably lean team. I think this was more of a strategic decision. Look, and I would credit my ownership group for really, we dug into strategy, because like we're like, okay, well, like, not to be, but it was like, how do we not get our ass handed to us again, like we did in 2020? And I've got a lot of credit for diversifying prior to 2022, but it wasn't, just to be transparent, I mean, there was a reactivity to it that was going back to now. People, when we were in 2021, people are like, "Why would you sell to the insurance company for this lower execution when the securitization market was bubbling the way that it was?" And I would just go back and tell the same story, going back to the first quarter of 2020. But I think that the moral of the story is that diversification is critical. And when I talk on a panel or I talk to a constituency at a conference, or I talk to our clients directly, I said, look, I mean, if you're going to take the time to develop relationships, which you've got to put a lot of time into them, just deal with people who are diversified, I think. And I certainly don't tell, our client base that you should be dealing with Constructive exclusively. Diversify, that I'll expect too. I mean, have, more takeouts for, whether you're a broker. I mean, you shouldn't be single threaded to any one lender. Whether you're a lender, you shouldn't be single threaded to not only any one takeout, but any one type of takeout.
With that year when you guys started with the live codes, would you say that was kind of the breakout year for you guys?
What year?
I would say you said 22, right? 21, 20, going into 22, you started diversifying capital strategy.
2021, everybody did well, right? I mean, it was just an historically accommodating environment for mortgage banking in general, not just residential investor lending, not just non-QM lending.
Everything was hot, right?
Everything
at the
was
time,
hot, and rates were obviously accommodative, and there was just a ton of liquidity in the market. But that transitioned really quickly in 2022 when the Fed started to raise rates, and I think you started to see the securitizers especially go like, wait, I don't know if we can aggregate this stuff fast enough to get deals out in the market, to really offset the interest rate risk. Even if you were hedging, I mean, you still were seeing these deals that were getting caught underwater, executing really bad on a relative basis. And there just wasn't a lot of prints of deals that were in the money because rates were moving faster than you could buy it from the originators.
right? There's so much uncertainty. So, but the decision to start working with LifeCode, did that allow you guys? With that, I would say, kind of from a internal perspective, was it a all right? We've got some horsepower now. We've got a lot of market. We're building more market share. Was it kind of a breakout moment for you guys?
It gave us some confidence, but it wasn't just the Lifeco. It was how we were taking the money from the Lifeco, and it was the forward commitment concept of it. And if you go back to 2022, well, if you were locking in forward commitments, just the nature of it, right? Because you're locking in the price before you take it into production. If rates are going up 10 out of the 12 months out of the year, you're going to do well, right? Just as because you're kind of riding the macro trend. Now, that's not exactly, we were not trying to analyze the rate market. We were just trying to manage the rate market, right? I mean, I didn't know if interest rates were going to go up, down. I don't know to this day. But, you look at it and you say, okay, if I was locking in before the period that the capital was in effect, like you were doing well because rates were going up almost all of the time.
You wanted certainty. You wanted to avoid volatility. You wanted certainty, but you weren't sure. But there was a little bit of a risk decision too. You're saying.
So look, there was a few months where we locked in, rates kind of came down in a subcycle, and our rates were either higher than maybe where the market was, or we had to work for a little less, right? Because the cost of capital was higher, but we also had, diversified that with some index weighted secondary marketing activity where, I could go back and get the execution, right? If rates dropped, there were certain price models that we were selling into that would give us better execution. By the time you weighted everything, on a month like that, it might not be super exciting, but it was at least palatable and profitable.
I want to hear more about like how you were managing the team at the time too, right? Because you guys have a team. We work with many of them. A lot of folks at the events and come out to the shows. They meet the forward facing team, but we know that you've got also a very robust back office. there must have been a lot of chaos and a lot of uncertainty and a lot of ups and downs during this time point in time. As a leader, how did you manage all that?
Yeah, well, transparency, it was one of the biggest. And I think if you talk to anybody at Constructive, it's funny because at Constructive, and not everybody has taken this approach, right? But we've taken a very, very residential mortgage banking flavor to residential investor lending. Not everybody does that, right? You could look at like, and you talk to like maybe Eric at Rock, he's a capital guy, he's a commercial guy, right? I mean, so he's not as transactional maybe as our DNA is. But if you look at myself, Tess Siwa, I mean, we all came from residential mortgage banking. So, the way that we look at things, and the way that we set up our processes and the way that we hire is just kind of in line with that familiarity. But here's the deal. I mean, mortgage banking cultures are difficult, right? Because all of the experienced people have gone through cycles, either been laid off, witnessed layoffs. I mean, because it's so rate sensitive on the conventional side, right? So you're talking about it being fragile. Those people are always on edge. You kind of throw in the market dynamics that, we've been discussing, and it's on steroids, right? So one of the things that we do is, if you're familiar, so we have a quarterly, what we call a town hall, which is just, lack of a better term of just have a quarterly meeting. We review production, operating results, initiatives, what's good, what's bad. We recognize our people, just that type of a meeting. But at the end, we opened it up to a Q&A. And for years, we didn't get anything. Nobody was going to get up there and just ask a question of senior management. So what we ended up doing was we implemented Slido. So if you remember Slido, which quite honestly we picked up from the IMN conference, where you can ask questions anonymously, and man, the engagement goes off the charts, because nobody knows who you are. I know, you could, like, these people could do whatever they want. They could say all kind of bad things about me or whatever, but but I think what ultimately happens is you got really good questions, but the questions that we were getting, and when I told HR that I was implementing, they're like, "You're crazy." They're like, "You're absolutely crazy to allow anonymous, unfiltered," But that's what we did, but the questions were, to your point, are we going to shut down? Are there going to be layoffs? Why are all these other lenders laying everybody off? Why are all these other lenders shutting down? So we had to tell the story. So we had to tell the story of, look, there's no company out there bigger than the market. I don't care who you are. This is what we're doing. This is why we're different. This is why we're a little less rate sensitive. And that gets into just the investor story. But here's what we're doing with interest rates. Will it work forever? We don't know, but we believe it's the best practice in the market right now. And it certainly worked up until this point. And I think now people are pretty confident. But you and I spoke offline. As crazy as this production is at Constructive, there's seemingly a little bit of a fragility to it, right? I mean, and you're hearing that throughout your ecosystem and your client base also. And I concur with that sentiment. But it's definitely been a very, very interesting, exciting 90 days.
Who would you say was kind of like you're looking back on the past 7 years, like, okay, this hire really helped us turn a corner, right? You got to give credit to somebody on the team.
Yeah, no, I think there's a lot of that. I mean, like Alex Offit's not with us anymore, but I mean, he was certainly influential, in bringing volume up, I would say throughout some of the, just throughout some of our maturity. Now, That being said, the guys who stepped in are just doing an amazing job, and that's look. I mean, that's part of the reason we are where we are. Um, but Tess Siwa has been. I mean, she just knows more about mortgage banking than than anybody. And I think when you have that level of knowledge, and you go back and say, okay, like, well, what is your client base looking for? Because one of the things that gets lost a lot of times when you're talking about constructive and their diversification, the fact that we can put very competitive, pricing and terms out into the market is we are like obsessively focused on how to build, maintain, and strengthen our client relationships. So it runs a lot further than product and price. I mean, we partnership in a lot of different ways. Some of it's marketing related, but one of the things that you'll find, especially in this market, because the 7 or 8% DSCR market, for instance, is not the same as a 3.5% market. Loans are more difficult. File quality is more lousy. There's more manual intervention, and you still ultimately have to keep your exceptions to, about 15% or less of your overall origination population. Like, you just need critical thinkers that can make decisions quickly, especially when it comes to escalated files. And I think, one of the things that we've done is really, I don't know if we've mastered it, but I think we've come a long way. So we've done some things systematically where we can really get answers to people fast. And I think from a risk management perspective, Tess and I have come even more back into the day-to-day. And I found that, just being a part of that process has given me a really good pulse on risk management. I can kind of see what's coming through, and I see the difficult files, and I think, make some logical extrapolations to what, the rest of our pipeline looks like. So, I mean, she's obviously, can just kind of handle so many things that, that's been big. But I mean, I could go on and on. Ben Jackson, I mean, he's been in the last 90 days, with Cal Cannon and Mike Fuller, just taking this thing to the next level. So I think it's been a lot of people. But interestingly, we brought the senior managers back into closer to the business. And there's a lot of, I haven't seen many lately, but there's a lot of studies that have been done by I don't know if you're familiar with a Garrett McCauley, who's so they're warehouse diligence guys, but they also have a big consulting business, been around mortgage banking forever. That if you've got a senior management team or CEO that knows every aspect of the business, you get better margins and better operating results financially and those types of things. And I think that's what we do. But the people are just amazing. I mean, if you look at the amount of loans that we do per person, I mean, good luck. And look, and that impacts your cost to originate. And, that cost to originate gets passed back to our clients, through our pricing. And I don't know if everybody's focused on it, but when, if you get to a point where the market becomes commoditized, or the securitization bid's just the best bid out there, and a lot of people are working with the same counterparties, and, you need something to differentiate yourself. And I would encourage, at least businesses that are at some level of scale to really perfect their cost structure.
That is a question I wanted to ask you, because clearly you guys are different than your average private lender out there. A lot of them are your clients, right? But there are always uniform challenges that every business faces, right? No matter what you are, right? It doesn't matter how big you are. It doesn't matter if you're national, local, institutional, retail. It doesn't matter, right? There are fundamental uniform problems that every business will face. And, you guys have been able to achieve a lot with a very lean team.
I mean, we have a big team, don't get me wrong, but I mean, relative to production, it's
Well, let's get into that. So, give me total numbers right now, because let's get like like you guys started with just two people. Where are you guys at now from a body count standpoint, like total people?
160 FTEs. We've got some overseas support, but not very many considering. I mean, the number of loans going through lightning talks. I mean, so I think we're proud of that ratio. I think it enables people to do very well over here. We try to variabilize the comp plan so that we're not putting limitations on people. And interestingly, I mean, I just never seen the culture here better, and I certainly don't attribute it to me personally. It's just, I think sometimes the people just have to do it on their own, and that's what's happened. And I've tried to kind of stay out of the way of it.
So that's one of the questions I want to ask you. Like, so when it comes to any business, and you guys are hitting, your stride and really taking, and really realizing, the growth potential, and you kind of hit those numbers, and you hit the size that you're at. But one of the always key question is talent, right? And talent is one of the hardest things to come by in our industry. It seems to be both recruiting good talent, but retaining good talent. And this industry is remarkably incestuous, and so people bounce around houses. Like, what have you guys been doing to keep people on board and get good talent on board?
We're getting kind of a break right now, right? Because the conventional mortgage banking business really isn't back, firing on all cylinders, and it probably won't be. So there's good talent that's available. But here's what I would tell you that we focus on, and I don't want to come across overly cliched, but you can look at somebody's experience. And I've had employees and one sticks out and is still with me, that had worked with me all the way back to the Jordan Capital days. Actually, you could have employees with commensurate backgrounds, were a loan processor conventionally somewhere, maybe became a team lead. I mean, and one of them, if you bring them into private lending or residential investor lending, whatever your preferred term is, some of them will just thrive and run with it, and other ones will implode. So you start looking at the first line of any resume. Hey, what do you do well? I mean, well, I'm hardworking, critical thinking, team oriented. Now, look, everybody's going to put a good tagline up there. But if you look for that, it's such a relationship sensitive space, right? Like, I've got a broker client who is sending me recurring business. That broker is dealing with a residential real estate investor that's sending him recurring business. It's layered relationships. Everything you do is more under the microscope and has a more residual impact, right, than if it was just a conventional loan where you might see a borrower again when they refinance in 4 or 5 years. So you've got to have those people, because, it's not, the problem is that and this is life, right? The relationship gets defined on the small percentage of the loans that have to be escalated, have issues. I mean, that's what people remember. So you got to get that part right. And we do a lot at Constructive. I mean, we look at, efficiency training and integrate, whether it's Lean or Six Sigma. That stuff's important. And I think, the other thing is that you've got to really talk to your clients about what's important to them. I used to think we just got to get our turn times down. We got to get our turn times down. We got to get our turn times down. And I think it was just probably because it was something that was out there. It was almost lazy on my behalf, right? It was very easy to measure. You can kind of calibrate, know where you're working against a specific target, and you can look at trend pretty easily. But that's really not what the clients want. The clients want you to do almost all of the loans in a reasonable amount of time. And then when the one they need to get done fast, be there and be ready to execute. The one that they need you to work through because it's got an issue and it's an important borrower of theirs, be there and be able to execute. So, and then when you get that information, you're like, okay, well, I got to change the way I'm managing this. I got to take a look at my processes, and and it's a lot of iteration you find, but it's some of that stuff sounds like it's fundamental, but I'm not sure that it's being done across the market.
But it's a very hard challenging thing to impose on people, both back and front office. It's like, "Hey, you're gonna have to be there for them, and it's gonna require you to go the extra mile, and it's not gonna be fun. It's gonna hurt, but it's gonna pay dividends."
You're absolutely right, right? And like you got to balance everything, right? I mean, so you have to still balance it with, the risk profiles you're looking for, right? Which requires you saying no to somebody that you don't want to say no to. In the same way you have to do it on the legal side, right? Like, hey, I'd love to give you this opinion because you're a great client and whatever, but it's just not legally inclined and I can't do it. And we're all in that situation, and it's just how you navigate that situation. And look, I mean, sometimes you don't have any discretion in what the ultimate answer is, but you have a discretion in how you deliver that answer, and and how you deal with it. That's for sure, right?
I know your team, you have it's 160, and they're not all in your office, Chicago, right? They're everywhere, they're all over. What resources have you instituted from a production standpoint, but also from an organizational management standpoint, for a technology standpoint, to really make things more efficient? Because my understanding is I mean, we run a remote team as well. We have a lot of technology in place to mitigate a lot of pain. What are you guys doing? What have you guys built out?
Our LOS is cloud-based, right? I mean, so it's easily accessible. We do have the ability to. I know our employees hate this, but I mean, we can see their activity in the LOS, so we can see, we have audit trails on what's been updated and so forth. I mean, there's not a lot of people at Constructive that are kind of lying around and not working, but I mean, we do have those tools in place. One of the things that we're looking to transition to is we've got a phone system in place, which is fine. We do use Teams and Zoom, but I really do like the Ring Central functionality, because I think like right now, we're probably going to transition from this merit-based hybrid system to fully remote. And the Ring Central stuff's pretty good. There's others that are just as good, I'm sure, that are competitors.
It's been Central for years, and we tried other, and like, it doesn't get better than Central. It
So
seems
what's
like.
funny
So.
is, you hear, and look, I think a lot of it's just nonsense, right? I mean, you hear the AI, and it's like, yeah, okay, right? Because that's just the most overused term out there, right? I mean, like,
It seems like almost when I hear AI today, it's like almost like, okay, I'm not real.
no,
It's a
1,000%,
sign that it's not real yet.
1,000%, right? You're like, oh, I've got this AI-based engine, and it takes 30 variables into consideration, and they tell you loan eligibility. I'm like, wait a minute, like, hasn't Fannie Mae and Freddie Mac been, doing that with like thousands of variables and with the tightest sensitivities, with like trillions of dollars of loan data? And they've been doing that for like 45 years. So what makes yours AI and just makes theirs a machine learned algorithm? But I'll tell you the one thing about the only AI that I've seen that is like somewhat frightening. I don't know so Ring Central's got the functionality where it summarizes the call. I don't know if you've seen it. I'm like,
Oh yeah, I've tried it.
that's
It's
crazy.
fun. Yeah, yeah. It's not recording it; it's just listening and.
And it summarizes all the key points, and you're like, wow, this is, but no, I don't. You could go to Rocket, to UWM. I mean, you tell me who's got any real. I mean,
Right. And then on the front end side for production, like what besides the LOS, the measurements, I mean, any tools for your reps and your people, your closing team, and that to make things turn faster.
yeah. So obviously, I mean, not to plug it, but we use Lightning Docs on, I'd say the overwhelming preponderance of the closings, all the DSCR closings. We do have some manual docs that we that are state specific in nature. on the RTL side but it's, it's de minimis. We've got a portal that was built by a developer on the front end, which is really good. I mean, so it's taken, it'll take in a file. It's got document management system, so you could put a full submission and run it through. And then after,
Your brokers.
what it does is kind of pushes our LOS out into this application, and then
So they can interface with the LOS.
yeah, it's interface with the LOS. So, then, post conditional approval, you can use it to send us conditions and those types of things, see your pipeline, get loan statuses. And then one of the things that we're looking at, right, and I think, that we haven't done a very good job with is really trying to get more market share out of what I would call the conventional broker market. So, look, I mean, we do really well in the private lending ecosystem. We deal with a lot of clients, to your earlier point, that are also lenders, that may have a great RTL business and do their DSCR as our partner. But we haven't done well, and neither has anybody else in this space, quite frankly, with the conventional brokers who really could benefit from our products, because
A highly sought after market, but no one's really cracked that nut. Yeah, you're right.
and I think one of the things that you got to be able to do is take in a Fannie Mae 3.4 file, for instance, and then you've got to be able to distill it to, because you can run into some compliance issues depending on what information you take in. Some HMDA issues actually, but so I think that's, and whether we can build that in our current application,
So make it easier for them to interface with
That's
you
correct. That's correct.
and what they're used to doing.
That's correct, 1000%.
Right, is what I'm hearing. So then it becomes an easy transition, because they struggle with the way things are run on this side of the business, right? Because they're not used to it.
1000%. And then maybe we, you, myself, and Nima or Melissa talk about how do we deal with the entity review if you can get this thing to kind of scale, right? Because that's another, they just don't have inherent knowledge of those types of parts of the process, right?
Yeah, I remember talking to your team about that. Yeah, I mean, it's a checklist issue. If you can build a checklist and they follow it to the letter, that's the hard part, getting them to follow it to the letter.
But
right?
I mean, but look, there's upside. There's upside when it comes to that market.
Massive upside
as well,
yeah.
right? I mean, we have a pretty well-known LOS that, from our perspective, the number of loans that we're running through it in any given month, managing a $300 million pipeline, you want stability, and so I think we've got the LOS, we've got the front end portal, we've got Lightning Docs. We're working on the integration with Lightning Docs, which I think is going to be done, from what I'm being told, fairly quickly. So that's exciting. It gets back, and I think that gets back into, we're thinking that could take, give or take, 20 minutes. This has been told to me by the last two closing managers actually that we've had. So look, I mean, that goes back. I mean, the cost of that is tangible, right? I mean, so if you continue to just kind of work on those efficiencies. So look, I mean, we'll probably integrate Ring Central. We've got a CRM that is, that we're probably not using to full capacity, but I think
that's the truth with CRMs.
we're just, so I don't think we're doing anything remarkable. I do think there are some opportunities that stretch beyond just bringing in like a Fannie Mae 3.4 that are available, with some decisioning engines and just some eligibility and price type of tools. And you've seen it out there on some level. I think Kiavi does it fairly well when it comes to their direct borrower distribution. But I think, there's some nice opportunities when it comes to, just a third-party client model.
I want to transition to now kind of getting your take on where we're at right now in the marketplace, because you're very well known for having a good understanding of where things are at upstream, but also kind of how it impacts us at the local level. And you mentioned earlier, right? There's people are busy, volumes are up. With many lenders, they're all saying their volumes are up, but there's also this sense of uneasiness. There's a sense of, and the primary complaint that I'm getting is like, yeah, we're busy, but we're not the right kind of busy because we're having to say no a lot. We're getting a lot of bad requests. We're getting a lot of guys trying to slip through the cracks, and that leads to fraud, right? We're getting a lot of things that scream fraud, right? And I'd like to get your take on things because the volume that you're doing, you must be seeing it.
Oh, yeah. I mean, so interestingly, so look, I mean, I think my assessment at the high level is like, you and I were around when the DSCR market was 3.5, and you were seeing 7 handles on RTL, and the market at 7 to 8 DSCR and 11 to 13 RTL is a different market. And you combine that with the fact that, opportunities are more scarce because of the supply constraints in the real estate market in general. And you're getting a lot of, people kind of taking flyers. So we've seen it from a fraud perspective. And I think, constructive, for instance, I mean, and where we've been from a production. I mean, it's not like, we started producing a lot of loans like a short time ago. We are going to most likely, have a month where our production is 40 to 45% higher than our second biggest month ever, which is just the biggest month behind last month. And you look at it and you're like, wow, that's amazing. But at the same time, a part of it, thankfully, is because the average loan size has come up a little bit. So it's not quite as dramatic on units. But you're like, wait a minute, we got to go back and look at, how do we feel, relative to risk management at these levels? How do we feel about our capacity models at this level? How do we feel about our QC at this level? Right? How do we feel about our client response times and client experience at these levels? And so I think, the sentiment that I think I use the word fragility, and I've talked about it internally. I've talked about it at home with my family because I'm like, it just doesn't feel, I'm not saying that it doesn't feel solid. I think it's all on solid footing, but but you certainly can't get complacent, and you do have to keep looking. Is there a shoe to drop here? You saw the equity markets have the issue at the beginning of last week, I believe, right? You saw the securitizers change price. I mean, so it was like, but it was very, very instantaneous, and you just kind of get the sense that everybody is just kind of on edge. And I think if you look at that through the lens of like, well, wait a minute, we should be at the top of the interest rate cycle. I mean, right? I mean, like, I think most market sentiment is that, the Federal Reserve is going to cut. Now, that doesn't necessarily mean the relevant rates in the middle of the curve are going to go down or up, but I think that the sentiment compared to what it was is better from that perspective. But yeah, you're not seeing it in the broader market in terms of like tons of confidence.
But you made a very, very good point, because the pricing is informing the amount of risk that's being taken, because it's causing people, because folks that would be on the sidelines or something on the sidelines, it's the guys who are pushing the harder transactions because they have no choice.
At some level, right? But it's probably on the margin, but that's all you need, right, to create a big freaking loss.
It's not a lot of cases.
Right.
You need one or two that really high profile ones that cause problems.
So one of the things that was great about our industry is like the real estate investor, the underlying borrower to us, the real estate investor finds value in the acquisition, right? And it's like, if I can get this property and model it, I'll take care of the cheaper financing later on when the market gives me that opportunity. So, but then you start to get some of this stuff sprinkled in that's either bad, just a bad actor, or just too creative, whatever it might be. And, we're seeing that, and it makes it difficult because, you got to go back and you got to have these difficult conversations with clients. I mean, you and I talked offline. Look, we took a loss back in early 2023 on five properties I believe it was 5 properties in Tulsa, where it was, I mean, it was just outright, it was just fraud. And, thankfully, the economic wherewithal of a constructive can absorb that, but it was, but it was painful. And but I think that if you go back and you look at the way that we've approached the business, we always had best in class loan performance. I mean, the other thing that we have that's somewhat unique is our affiliation with the servicer gives us a lot of visibility. So, look, we have visibility on just under $5 billion of historical DSCR production. And we've seen some slippage, right? I mean, we used to have 60-day plus delinquency around that 1.5 level. Now it's about 2.3, and interestingly, but there's no real bias towards like the recent vintages, right? So some of that stuff's like coming back from 20. But when you do business with an insurance company, like you're married to that. They look at Constructive's performance every time they go in to price a new forward, right? I mean, securitizer, if you did something wrong where you breached a rep or something, you could have exposure to have to buy that loan back, or it's an early payment default. But insurance company, like you're married to the thing. And but interestingly, if you look at mortgage loan performance, I mean, it generally ticks almost exactly in line with the unemployment rate, believe it or not. This is going back to the mid 90s. I mean, before the mid 90s, like even if people lost their job, they pay their mortgage, believe it or not, but the 90s, it started to really become positively inverted. This isn't my information. This is straight from the Mortgage Bankers Association data. But, and then that got accelerated right in 2008. Like if you didn't have a job, you were never paying it was strategic default and everything else through the global financial crisis. And then like you've got some asset classes like conventional and banks that will perform, maybe a little better than the unemployment rate. And then you've got FHA and VA that might perform above it, but it all kind of blends out to about that unemployment rate. So we'll see what happens. We'll see what, and that's like macro and organic. But the fraud issue, every panel that I've been on probably in the certainly since the beginning of the year, it's come up as a key issue. And I think, go back and look at some of the leadership changes that you've seen, going back to, I think a lot of it started back in the end of 2022 in our space. And I think it was either something didn't function properly on the capital markets desk, or there were losses, some of which were related to fraud. So there's some tools out there. So I think, you see straw buyers are an issue. Straw buyers are more difficult to mitigate because of the way that they can manipulate the entity, right? Whereas you would see if it was just a conventional borrower, obviously, that the continuity would be more obvious. But the bank statements, I mean, these guys, there's programs online. You can go make a Bank of America statement better than Bank of America can make it. But there is some AI tools out there, or they call them AI tools, that I think I don't know if they can kind of snub every one of them out. But I know that they've been effective. So I think, one of the things that's going to come up is the industry is going to have to coalesce around some processes. I've talked about it offline with some of my peers. I've talked about it on panels. Maybe we need to go to a blend type of where, it's directly integrated, with bank account logins and those types of things. But it's going to take everybody, right? Because the second somebody doesn't do it, you kind of get an unfair advantage in your ease of use, right? So we'll see.
Probably easier to get adoption across DSCR than an RTL. I mean, RTL is a much more hard conversation to have.
And it's so much less standardized, right? I mean, everybody's kind of doing their own thing there.
And then not to mention there's a significant uptick in what we call creative financing behind the scenes before even the property is purchased, or as gap financing, or all kinds of strange creative strategies being done by kind of, I would say, local lenders and former real estate investors looking to chase yield. And it's all done in the shadows, and the lender has no idea what's going on, and it's scary.
Well, you and I have discussed this before, and there's a couple of issues, right? Number one is if it continues and it continues to a meaningful enough level, we're going to run into regulatory issues, which have been, that's one thing that's really kind of allowed the industry to scale, the industry to be, because look, if you look at a conventional origination, I mean, 35% of the costs of loan level costs of that origination is compliance, regulatory disclosure. So I think that's one risk. I mean, but the other risk is if you've got gap funding that you don't know about, you just got an illiquid borrower, or else why the hell is gap funding, so necessary?
You have no idea as to the financial condition of your borrower.
So you got a credit risk problem, and you got a potential regulatory problem. And it's easy.
It could have been an illegal loan too, like a completely non-compliant loan. So you've got all kinds of problems.
It's easy for me to talk to CEOs that, whether it's Jeff Tesh at RCN or Abramovich, we talk about risk all the time, offline and at conferences and on panels. And I think, for us to be able to coalesce is one thing. You would know the mid-market dynamics way better than I do.
Yeah, especially at the local level.
And I don't know how you get everybody together on the same page there. That's probably much more difficult than it is for myself and other institutional market participants, right?
Yeah, I mean, I think the idea of I would say source checking documentation that's being produced, that's relatively easy. Metadata is relatively easy to examine.
It's easy in its function, but is it easy if somebody else isn't doing it? What are the impacts on marketability?
Yeah, I mean, but I feel like it's one of those things where if the metadata doesn't really pencil out, that's a flag, right? You've got forged documents. You've got forged documents. You should just be cutting that relationship off anyway. And so it's one of those things where how do you evaluate whether the documents that have been produced are forged or not? And that's a metadata question, I think. And I'm sure we'll get there. I hear that issue everywhere though, which is nice. Like everyone faces that forged document problem.
Like I said before, you could go to websites that will allow you to create a JP Chase bank statement, a Bank of America bank statement, a PNC bank statement. I mean, and you look at these things and you're like, so there are a couple of things. I mean, we've done some things manually where we look to see if the interest makes sense. So if the interest is not commensurate to the balance on that statement, that's a red flag, right? Because I think you got to put in the figures. I don't think that the programs, calculate it.
Enough to figure that out. Yeah. But that's why I say metadata are usually those things. If you actually go deep enough into the PDF metadata, you'll find it. And that we've used that in litigation to actually have forensic metadata analysis to figure out whether it's been forged or not.
We found out the hard way on the aforementioned loss too, as we looked at when we broke apart the PDF. You saw the nonsense.
Yeah, you can tell if it's been forged or not.
You can tell if it's been manipulated. Yeah.
It's scary times, man. It's scary times.
It is. But look, we're gonna have to. If there's any bright side to it, we're gonna have to come together to deal with it, right? And if we don't, the same way that we've always talked about regulation, the same way we've always talked about compliance, an outside influence is going to come in and do it for us. And you know what? I mean, we know that we're not going to get as good outcomes.
Florida will try to license again, like the last time. New York will probably try to do the same.
I mean, rightfully so. If this is, where this is going, right? I mean, the loans are guaranteed and easy enough to look at that guarantee as a consumer.
I mean, California already instituted the equivalent of TILA disclosures to commercial transactions for non-real estate commercial loans. It's a matter of time before they start instituting that on commercial purpose real estate loans. We'll see. And they've been very hawkish on treating small business owners as consumers. And I think it's a trend that won't go away in the blue states. And our lenders are going to have to coalesce around figuring out a way to make sure that we mitigate fraud in our space. I agree. I don't know how we do it. There's been talk about, lists and agencies and organizations. I don't know about that, but
Well, you got privacy issues there, right? That would be easy. I mean, I think but there's privacy concerns when it comes to the practicality of that. So I think the one thing you could hope for is that if market conditions change, maybe you see less of it proportionally. I certainly wouldn't count on that, um, but no, I think, look, this market has gotten to a level where we got to solve these things, from
as an industry,
as an industry, from a macro perspective. You're 1,000% right. And if we don't, we kind of know what happens. I mean, just go. You don't have to look any further than Dodd-Frank, right? I mean,
yeah, left turn, right? That was the left turn.
it was a left turn, but I mean, and you go back and you look at it and you say, okay, well, there's a lot of problems with Dodd-Frank, and regardless of, because it kind of squeezed out the little mortgage broker or banker in effect, although that wasn't the intent of it. But if you look at it from a perspective of politicians, I mean, there was rationale for why that was done, for sure.
Yeah, I remember when Barney Frank spoke at AAPL, his rationalization made sense. He didn't see and he acknowledged he didn't think about the long-term effects of it.
You basically eliminated competition. You drove out, you put pretty prohibitive net worth requirements for brokers and bankers, but I think that you could see something like that again, and I think we have had some discussions with lobbyists on the federal level who go, I don't know that there's any votes to be gained in Washington by regulating loans to LLCs, but the states. Look, I mean, the states look at you, and it's this big enough industry, and it's a revenue source, and they kind of put you through the audits, and so I think at Constructive, I mean, we're ready for that, but it's all it all kind of remains to be seen. But the more institutional that the industry can act, and the more that we address some of these issues together at the macro level, I think it will have a super positive impact. Not really going on a limb, I don't think.
Yeah, and just I would let you know and let our audience know that the American Association of Private Lenders is working on something. They started a working group on this issue. I don't know the details of it just yet.
Test from Constructive's on that.
So I know that they're working on it. So I'm glad you guys are involved. I know we're involved. I'm not the person involved, but Steve, our head of litigation, is. And so hopefully that produces some meaningful results, and we can improve our standing out there and prevent a lot of this bad actors out there, and just focus on growing our businesses.
I echo that sentiment.
All right. Well, I think that's a good note to end the show on. Ben, thank you so much for your time. I will see you soon, live and in person.
Yes, looking forward to it.
Yeah, and for all of our listeners, thank you for tuning in to another episode of Lender Lounge with yours truly, Kevin Kim. Thank you for listening. You've been listening to Lender Lounge with Kevin Kim, brought to you by Gerasi LLP, the nation's largest private lending law firm. Gerasi is the leading legal resource for specialty lenders, asset-based lenders, private lenders, and non-bank institutions. Learn more about the firm at gerasilawfirm.com. That's GERACI lawfirm.com. Check out our episode summary to subscribe to our Lender Lounge newsletter and our Law Firm newsletter, where you can get notified about new episodes and recent content directly from our expert attorneys. In addition, we'd love if you follow Lender Lounge with Kevin Kim on YouTube, your favorite podcast platform, and on LinkedIn, where you can also check out updates from Gerasi LLP. Thanks for listening, and we'll see you next time on Lender Lounge with Kevin Kim. This is Kevin Kim, signing off.